Welcome and congratulations on entering the Inner Circle of Senior Living. The Inner Circle discusses relevant topics in senior living investment, operations, financing, and beyond to drive the industry to the next level. With a continually changing environment, let's start the collaboration now.
What is up, my senior living community and fellow passionate senior living fans? Welcome to the Inner Circle of Senior Living. I am your host, Scott McCorvey, and today's show is extremely important. You probably get the quarterly and monthly industry publications like I do. You probably also get the daily email blasts. Well, a lot of times these blasts and these different publications announce huge financing deals. And today, that's exactly what we're going to talk about. We're going to talk about financing specific to the senior living industry. Whether it be new construction, whether it be a refinance, maybe a bridge, a renovation project, an acquisition finance, we're going to talk about all the different product types that are utilized for the senior living industry. And it's extremely important because this senior living capital, this senior living debt, is really the bloodline of the senior living investment industry. If this capital was to dry out, which it has slowed down in the past, it really puts a damper on the senior living investment space. So extremely important to understand these different products. It doesn't matter what discipline in senior living you are, it really benefits you to understand what the financing products are. And so we're going to talk about those. Now, whatever product you work on, I definitely recommend working with a specialty lender. And the reason why is there's so many intricacies that go into senior living. So if you have to go through the underwriting process and you're working with a group that's brand new to senior living, you're going to have a much harder time and you're going to have a riskier time obtaining that capital. So I can give recommendations. Feel free to reach out to me. I know a lot of different people with a lot of these different products, but whoever you work with, definitely work with someone that has experience and understanding specialized in senior living because it is unlike any other real estate classes. Now we're going to talk about the different product types that are offered. But first, let's go over some terminology so we're all on the same page. Some of you might already know this, but it is important to understand what these terms are. So when you're talking with the different groups about the financing options, you all know what you're talking about. First, let's talk about loan to value or loan to cost. Sometimes it's LTV or LTC. Now, what this is the percentage of the amount of your total investment that a bank or a lender is willing to lend. And this is important because it's the concept of leverage. You'll have to know how much equity or how much cash you're going to need to put into your project. So the lenders are willing to loan a certain amount. It's typically between 60 and 80%. There's a lot of variables that go into that. And if you're going the high end, you're probably going to have more guarantees. And so we'll talk about that next. But for the most part, loan to cost, loan to value is the percentage of your total investment that a lender is willing to make. Talking about guarantees, the next terminology or term is recourse or non-recourse. Now, what this means is anytime you get a loan, your real estate itself is going to be collateral. Now, the difference between recourse and non-recourse is how much that lender can come after you personally besides the real estate itself. So this is just for bad case scenarios. If everything goes south, then the lender can foreclose on your property. But what if there's still a difference between the amount owed versus what they liquidated the asset, the real estate for? In a recourse loan, the lender can come after you personally, so you're still personally liable for any difference between the real estate value and the loan value. A non-recourse loan means they can't come after you, your personal business assets, because they can only claim the real estate itself. So extremely important term to know. There's different options and different products that have recourse and non-recourse, but it's really important to understand the ramifications of having that personal and or business guarantee on top of the real estate collateral itself. So that's recourse and non-recourse. Next, let's talk about interest. This is, the amount that you're going to pay each month. There's a few different types. There's interest-only loans, and that's exactly what the name implies. You're not paying any principal or anything else. You're just paying the calculated interest per month. There's also amortization or amortized loans. And what this is it's based on an amortization schedule, typically between 20, 30, sometimes 35 years, but you're paying the interest and the principal, and that principal is reduced from your balance each month. So you are paying principal and interest in your monthly payment. The difference really is interest only is a lower payment. The amortization is a higher payment because you're paying the principal on top of the interest. However, you're gaining more equity, right? So when you're paying down your principal and your amortization, you're gaining more equity. Lenders prefer the amortization to interest only because their risk profile goes down the more principal you pay. So that's interest only versus amortization. Next, let's talk about fixed versus variable interest. Fixed is exactly what the name implies. You come up with a rate commitment at the beginning of your loan, and that single fixed rate interest is for the life of your loan. So whatever your term is, be it 5, 7, 10 years, you're paying the same interest rate per month. Now, the opposite is the variable interest rate. And what this is it's calculated on some type of metric. Most of the time, it's off of the LIBOR. And then the bank or the lender will put a spread on top of that. So it reduces the interest rate risk for the lender, but it also increases the risk as the borrower because your interest rates can go up significantly, or they can go up modestly, or they could go down. It's not as known where a fixed rate loan, you know what your payment is each month. The interest only loan or variable interest loan will go up or down based on market terms. So traditionally, like I said, this is based on LIBOR. What's going to happen is they're going to give you a LIBOR plus a spread. So let's say it's a LIBOR plus 250. What that means is whatever the monthly LIBOR is, they're going to add 2.5% on top of that to come up with your interest rate just for that month. So let's say the LIBOR was 1%. Well, that 1% plus a 2.5% will be a 3.5% interest rate for that month. So that's the variable interest product versus a fixed interest product, which might be, let's call it 4.5% for the life of your loan. Regardless of if LIBOR goes up or down, you're paying the same payment, which is the same interest rate. That's the basic terminology. There's a lot more terms that go in there, but that gives us a solid foundation so we're all on the same page. Now let's go into the fun part, which is the different products specific to the senior living industry. The first one we'll talk about is a lot of times referred to as a balance sheet loan or a bank loan. What this is it's a loan that's actually held by an entity versus some of the other products we'll talk about, which are sold on the secondary market. A balance sheet or a bank loan is held on the books for a lending group. Because of that, it's typically shorter term in nature, right? So they want to recapitalize that capital. They want to get it using, so they're not going to traditionally give you, a 30-year term while they're sitting on that note. So it's traditionally shorter term in nature. A lot of times these local banks or these balance sheet loans are used for construction. And we'll talk a little bit about that later, but it's a lot of times they're used for construction or a bridge to go to agency down the road, but they're typically traditionally shorter term in nature than some of the other products I'm going to mention. A lot of times they're for all acuity types, so independent assisted, memory care. Some banks don't work with post-acute and SNF. Some work just with post-acute and SNF. So again, it's finding the lender that has a product to match what you're looking for. Now, when we talk about construction loans, construction debt, a lot of times what you're going to get is a product called a mini perm or mini permanent. Now, what this is, it's a mix between interest only for a lower loan payment during the initial construction lease-up period, which will convert to an amortized product once you're leased up and a little bit more stable and getting some cash flow. So that's a mini perm. And a lot of times, sometimes they'll have an exit already pre-planned to an agency loan or something like that. But traditionally, a mini perm will be, let's call it a 5-year term. You'll have 2 to 3 years of interest only, which will automatically flip into an amortized loan, traditionally 20 or 35-year amortization after those 2 and 3 years. So it's really getting a lower interest payment during that time where you're constructing and leasing up the senior living community, where your cash flow is not quite there to cover a fuller payment that's needed for an amortizing loan, because you're paying your interest and your principal. It's also used as a bridge product because, again, it's if you're having interest only for a certain term, call it 2 years, you might be going through a substantial renovation where you have to move residents around, or you might be having to move residents out for a short period of time. So for a bridge product, a lot of these mini perms or these balance sheet loans are used so you can do your renovation, your reposition, lease up your community, and increase that value and really be set to refinance and get one of these longer term products. The advantages of a balance sheet or a bank loan are, a lot of times it's the only thing available, or the only thing that's you have an option for new construction or reposition, renovation, things like that. Some of the other products, they don't have the flexibility that a bank or balance sheet loan has. Also, it's you usually get a quicker decision because the underwriting and the credit committee and everything is handled in-house. There's less hoops to jump through in getting a decision. So there's less folks that have to approve a loan on one of these products for some of the others that I'm going to talk about. So a lot of times you can get a shorter turnaround time. Some of the disadvantages, because of the banks are holding on to this product and there's a higher risk associated with holding on to it, a lot of times you'll get a lower loan to value or loan to cost than some of the other products. Also, traditionally, you're going to have recourse, so there's not a lot of non-recourse options for this, and it's a shorter term product. So you have to know that you're going to have to refinance it or sell it or whatever within a certain time period, and there's costs associated every time you finance a product. So think of that in the back of your mind as well. But that's the basics of the bank loan or the balance sheet loan. It's primarily used construction or turnaround situations. And a lot of times these bank balance sheet lenders work with an agency group too. So you'll have back-end options when that term expires that either you'll need to use one of the agency groups, or you can work with them on what they have on that side. Speaking of agency, let's talk about that. That's the second product type I'm going to talk about. Agency refers to Fannie Mae, Freddie Mac. Both of these, you probably heard them in the news quite a bit. It's a medium-term product, so traditionally between 5 and 10 years. And now this product it'll be serviced by a lender or group, but then it is sold on the secondary market. So there are prepayment penalties or defeasance associated with this product, and we'll talk about that in more detail later. But that's a big difference between the agency and the balance sheet, is that it is sold on the secondary market. So a group is expecting that coupon every month. So if you do repay it, there's penalties involved, and we'll go into that in a little bit, but just keep that in mind. It's most popular and used a lot for newer independent assisted living memory care. I actually worked on the first CCRC ever to go into Freddie Mac. So Freddie Mac and Fannie are opening up their horizon a little bit. There was a lot more education involved in getting that through the underwriting process, but it was part of the first CCRC ever to go through the Freddie Mac program. You'll get a little bit longer term than the balance sheet. Typically, it is a fixed rate financing. There are floating rate interest products that don't have the defeasance or the prepayment associated to them, or it's much lighter. There's groups that'll talk to you more about that, but just keep that in mind. Traditionally, it's a fixed rate because you usually get a really strong fixed rate interest for, call it 7-10 years, but there are floating or variable interest rate products as well that don't have that large defeasance associated with it. One of the great things about this product too is it can be assumed. So if you have really strong low interest rate debt and you still have maybe 8 years left on your term, you might have value creation there. If it's below market interest versus what a group can get in the market today, there's value in having that lower interest fixed rate. So think about that. That's, another advantage of having this product type is if you lock in a low interest rate and let's say a couple years from now, interest rates go up substantially, there could be value creation there. Now, on the flip side, if your value goes up a lot and you're assuming the loan, your loan to value is going to be lower than what you initially put on there. So there's give and take on that acquisition side. There's going to be more equity put in by the new group if they do assume the loan. However, there is the idea, this concept of value creation of having a below market interest rate loan. So keep that in mind. It can be assumed. Some of the other advantages, you could get a higher loan to value than some of the balance sheet loans. You could possibly get a higher LTV or LTC. Traditionally, it's the lowest fixed interest rates out of the different product types. A lot of times it's non-recourse or at least partial recourse. Some of the disadvantages are prepayment penalty or defeasance, and let me talk about this. So when it is sold on the secondary market, a group is expecting that coupon. So if you were to prepay it before the end of your term, that group is not getting the investment they initially thought. So in turn, what you're going to have to do is buy a product to counteract whatever interest rate is needed to satisfy the terms of the loan. So this can be pretty costly, especially if you're terminating the loan in the first few years of it. Then think of all those future years of interest rates. You're basically going to have to pay for it up front, find a product that's going to pay for that down the road. So there's a defeasance calculator, prepayment calculator based on where you are in your loan. But just think of, especially if you're selling it or whatnot early in the loan, there's a lot of prepayment penalties, a lot of cost associated with breaking that term. So keep that in mind. Also, there's usually a longer underwriting process that goes into it because there's specific rules and regulations that go into agency lending versus a balance sheet lending. There's more hoops to jump through. Also, there's limited capital options. We'll call it the capital stack, but a lot of times agency lending does not allow mezzanine financing or additional secondary financing on top of their loan. So keep that in mind. There's also higher upfront legal costs or closing costs that go into it. There's a lot more documents to negotiate. So just keep that in mind as well. It's a higher upfront cost than the balance sheet. So that's agency financing. Again, there's a lot more intricacies that go into that, but that gives a solid understanding. This product is used a lot, especially for newer communities that are stable, either refinancing, you can pull some proceeds out, or for acquisition financing, this product is used a lot, usually around that 5 and 7 year term. Get that low fixed interest rate, and that's, then you're off and running. Let's take a quick break. Next, we're going to talk about some HUD financing. We're going to talk about the financing and underwriting process. Got a lot of fun stuff in store, so let's take a quick break. We'll be back in a couple of minutes. This episode is brought to you by Senior Living Growth Advisors. Senior Living Growth Advisors can help you with the full spectrum of the investment and operation process. Whether it's structuring and closing new acquisitions, finalizing a development opportunity, accessing the specialized capital markets, implementing prudent asset management procedures, or just improving the operational efficiency of a community, let Senior Living Growth Advisors leverage years of experience and industry relationships to bring you to the next level. Visit srgrowth.com to learn more on how you can achieve your desired growth success. That's www.srgrowth.com. What's up, guys? Welcome back to the Inner Circle of Senior Living. I am your host, Scott McCorvey, and today we're discussing an extremely important topic in the senior living investment industry. Today we're talking about different financing options for senior living. So first went over some terminology as far as loan to cost. We talked about recourse versus non-recourse, talked about interest only versus an amortized loan, and also the interest, either fixed interest or variable rate interest. traditionally based on a LIBOR spread. We then talked about some of the different product types, the first one being balance sheet or bank loans. Then we went into a little bit about agency financing and some of the advantages and disadvantages of that product. The next one we're going to talk about is HUD financing. HUD financing. You're smiling or you're frowning right now. There's probably more frowning than smiling, but HUD financing is definitely a specialty product, and it is one of the products specific to the healthcare industry. It's used a lot in skilled nursing and some in assisted living, and even there is a good amount that's used into new construction or development of assisted living. So we'll talk about that product right now. There's absolutely specialty lenders that just do HUD financing. So absolutely work with one of them because they understand the process and the queue that goes into HUD financing. Now, some of the things is it's very long-term fixed rate financing, and that's the great thing about it. We're not talking about, 5-10 year term. We're talking about 20, 35 year term. So this is extremely long-term, low interest, fixed rate financing, and it is backed by the government. Because of that, there's a lot of underwriting, a lot of government intricacies that go into obtaining this financing. And your lender will work with you on this, but just understand that there's a big queue, especially with the government shutdown that happened. I'm sure it didn't help things, but there's a large, long queue associated with this product. So it's not something you can get in, 2 or 3 months, 30. If you have 60 days to close, this isn't the product for you. This is something that if you need to refinance 9, 12 months down the road, this is a product that you can think about. Again, it is most popular in SNF. There is some definite options for assisted living as well. It's insured by the government. It's non-recourse. That's something important to remember. Non-recourse. So if you want long-term, non-recourse, low-interest, fixed-rate debt, those are all great things, right? This is a good product for you. However, the downside, and we'll talk about a little bit more, is the long underwriting and queue process. It's not something that you can turn around in a couple of months. It's something you need to plan months and months ahead of time. Let's talk about the underwriting process. So the government several years ago, they switched because there was so much complaining about the timeline associated and the queue associated with a HUD loan. Well, they developed a new product called Lien, which in theory was supposed to reduce the timeline. And I think it has in some aspects, but there's still a lot of time associated with underwriting this product. There's also a lot of additional costs in underwriting this process. So just speaking of one, you're going to have to get a HUD approved appraisal, which has a lot more levels of detail than your traditional real estate appraisal. So a traditional real estate appraisal might cost $5,000. Well, a HUD appraisal might cost $15,000. So that's just an example of some of the the higher upfront costs that go into getting HUD financing. This financing usually can be assumed. So again, we talked about creating value with really low interest rates, and especially environments like now where interest rates are projected to go up in the future. There could be some value, some really good real value creation in having this product. However, there are some prepayment penalties associated with this as well. It's not as intense as agency financing, but typically within the first 7 years of the term of a HUD product, there is some type of prepayment penalty, so keep that in mind. Some of the advantages are long-term, low interest rate, fixed rate debt. Those are all great things, right? So really good advantages. It's non-recourse. It can be assumed. All that sounds amazing, right? Well, the disadvantage is an extremely long and arduous, I would say, underwriting process. Again, you have to work with the HUD program, the Lien program. They have specialized software. They have specialized underwriting. They have a long queue because they only have so many people working on this. So it is a longer underwriting process, and the information that you're going to have to gather and give is more than any of the other product types. Again, there's higher upfront costs. You need specialized market studies, specialized appraisals. All those have certain detail levels that are higher than traditionally seen in those types of studies. You have that prepayment penalty within the first 7 years. And again, you're dealing with a government process. So just be prepared. Like I said, there's a lot of great advantages to it, especially if you want to lock in a low interest rate now and have a long-term product. Just be aware there's a long underwriting timeline associated with it. There's great specialty lenders. Feel free to reach out to me if you need some recommendations, but that's the HUD product. Now, those are the three main lending products: the balance sheet or bank loans, agency financing, so hitting the Fannie and Freddie markets, and then also the HUD product. Let's talk about some specialty products now. Now, this is capital that's traditionally put on top of a senior debt source. So if you're getting a senior debt source called a balance sheet loan of 75% of your loan to cost, well, that means you're going to have to put in that 25% equity. Well, sometimes some groups don't have that equity, or their cost of equity is more than the cost of some of these specialized products. So let's talk a little bit about them now. First one being mezzanine financing, and there are specific mezzanine financing groups specific to the senior living industry. Feel free to reach out to me. I can give some recommendations, but there are specialized groups that provide mezzanine financing just for senior living. Why would you need mezzanine financing? Again, it's more of a shorter term product that gives you higher leverage, or being able to get a higher loan to value or loan to cost. So you don't have to put in as much equity. You might not have the equity, or your equity is, you want to spread it out between different projects. This gives you an option to do the project, to break ground, or to do your renovation, or whatever you have in mind, your acquisition, and not have to write as big of a check. However, there's a lot more cost associated to this product, and we'll talk about that now. Another concept to think about actually in the mezzanine product is it is subordinated. It's in a second position, but it does have a position on the real estate. So your senior debt, if again things go sour, your senior debt or senior note will have first dibs on any value, any liquidation of the asset. Next would be your mezzanine financing. They would have a second position on any cash available. So if there's no cash available after the property is foreclosed and liquidated, then they receive nothing. So it is a riskier position. That's why the interest rates are higher. Again, we talked about higher risk, higher reward. This is a riskier product for the lender because they have a second position on the real estate. However, they do have a position on the real estate versus preferred equity, which we'll talk about next. You can leverage this product. So let's say you do have, loan to value on a balance sheet loan of 75% for a new construction development project, but you only have maybe 10% of the equity. Well, you can use this mezzanine financing for 15% of what we call the capital stack. So 0 to 75% of your total development budget will be the senior bank financing. On top of that, an additional 15%, or all the way up to 90%, will be this mezzanine financing layer on top of your senior note. So then you're only having to produce 10% of your total development budget in equity versus that 25%. So that's one reason that it's used. Also, it is typically a shorter term product. It has a much higher interest rate. We talked about higher risk, higher reward. So be prepared for a much higher interest rate than any senior lending product. A lot of times there's also, I call it a kicker, or some kind of value creation upon sale. So you'll have to pay a coupon each month. On top of that, when you refinance it or you sell it or whatever, a lot of times there's a kicker for the lender to catch up to a certain total IRR or certain total return threshold. It's used a lot for new development or acquisitions with substantial renovation. Because of that kicker, you really need some value creation to cover those costs and really make it worth your while. It's likely cheaper than your cost of equity, so that's a definite advantage of this, depending on what your equity is. If it's, if you're doing private equity, if you're doing family office, you're doing your personal equity. The mezzanine financing, even with the kicker, is typically lower cost of capital than your equity itself, so keep that in mind. And there's absolutely specialty lenders that provide mezzanine financing just for the senior living industry, so work with one of those groups. That's mezzanine financing. The biggest difference between that and the next product I'm going to talk about, which is preferred equity, is mezzanine finance actually has a position on the real estate itself, where preferred equity does not. They have a higher position than your general equity, but they don't have any kind of position on the real estate. And that's important for a number of reasons. Mezzanine financing sometimes is not allowed in different loan types. So a lot of times agency financing is like, hey, I don't want any other groups to have claim to the real estate besides me. I'll give you your 80% loan to value, but there's no other groups that are going to have claim to the real estate. Well, mezzanine financing, that doesn't work, right? Because they want a subordinate or a second position to the real estate. So that's something to keep in mind when you're looking at these different product types. Preferred equity, which is the next specialty product I'll talk about, they don't have any position on the real estate. So they could, in fact, work with agency financing because they don't have any claim to the real estate. However, they do have a higher position in cash distributions than traditional equity. So just think, whatever cash is produced by the real estate, that preferred equity is getting their check before you're getting your check. So keep that in mind. Again, the biggest difference is they have no position on the real estate itself. A lot of times it's a higher coupon. It's definitely a higher coupon than any kind of senior debt. Sometimes it's commensurate with the mezzanine financing, but again, it's higher risk, so sometimes it's a little bit higher, and it's a higher position. Preferred equity has first claim to traditional equity, so keep that in mind. However, preferred equity, they can or they cannot have what I call a kicker or a catch-up or a total return associated with the product. So that sometimes it's just you pay this coupon for the life of whatever term you come up with. So keep that in mind as well. Those are the specialty products. Now let's talk about, we understand these different products specific to the senior living industry. There's the balance sheet, the agency, the HUD, some specialty products out there. That's all great. But what's the actual lending process? What does it take to get from start to finish? What's involved in going over the finish line? That's what we're going to talk about next. And there's a lot of things that come up during this process. So no capital sourcing product or process is the same. But I'm going to give you a general guideline of things to think about or to understand on how to obtain the financing and the processes involved in it. Just be aware, there's going to be a lot of things that pop up along the road during the underwriting process, during the commitment or rate lock process. A lot of, what we call fires that pop up, and you're going to constantly be running around juggling, closing things. Nothing ever goes perfectly. So just be aware of that. I'm happy to help out during this process with you. There's a lot of other groups that have experience in going through this process, but understand that I'll give you a general timeline, a general guideline to this financing process, but there's a lot of things that pop up. Keep that in mind. So what's going to happen is, okay, you need this financing either through an acquisition, a new development, a major renovation, anything like that. You need some financing. The first thing to do is really understand what your timeline is. Again, that's so important for these different products. You have to understand what your product timeline is. If you have to close within 30 days, that limits a lot of your products right there, right? If you have 3 months, if you have 6 months, if you have some time on your hand, that opens your horizon on what you can do. So first thing is get a solid understanding of what your closing date is, when you actually need to close on this capital, and also what you're looking for. Is it a short-term product? Is it a longer-term product? Can you provide recourse? Are you not comfortable with recourse? These are all things to know before you even start discussing this with lenders. Understand what you're looking for and what you need. The next step would be reaching out to these lenders. Again, I recommend senior living, specialized financing lending groups that understand the industry. Reach out to these groups and talk about what you need, and then feel them out on what products they have. There's always new products that are out there, and these groups have a solid understanding of what's being sold on the market now, so they understand and know the timelines, the interest rates, the loan to values, everything that goes into a financing decision. Talk with different groups to really understand what the current market terms are for the different product types. The next thing would be to provide the initial information. So once you talk with some groups and you have a solid understanding of what product types you'd like, you're going to have to provide them with some basic information about your property. Traditionally, it's your couple of years of financials. It's probably the balance sheet of the operating or ownership group. It's going to be a few months of rent rolls. It's going to be a few years of occupancy information. It's going to be pretty much what the initial information you'll need to kind of size up a loan, understand the performance of your community. You'll probably have to give the budget, solid understanding of your leadership experience and the operator manager's leadership experience. Just kind of a broad range of what they'll need to initially size up the property's performance and what they can loan on. So that's the first thing, is provide the initial information. Once the lender has that, they'll talk with their different internal groups. They'll go over the information, do some initial underwriting. They might follow up and need some additional information, or they might have some questions on your performance. Maybe you had a dip 1 month or whatnot, some fluctuations or variances they need to get a better understanding on. Once that initial information is underwritten and the questions are answered, the lender will either not do anything and say, hey, this isn't for us, or they'll offer you a letter of intent. This letter of intent is going to have your basic business terms of the loan. Most important is the loan amount itself, so what the loan to value is. And they'll give this loan amount, but also remember that your appraisal is going to have to support this loan amount, so it'll be subject to an appraisal. They'll give the loan amount, loan to value. They'll provide the term, provide any guarantees that are needed, what the interest rate is, or the calculation, LIBOR plus, the spread, LIBOR plus 250, LIBOR plus 300, whatever it is, as well as a basic timeline of the amount of time they need to close the loan. So this letter of intent is your basic real estate terms that go into the actual commitment, which you'll receive down the road. But this just makes sure everyone is on the same page for the major business terms of the loan. Now, these terms can be negotiated, so you might not like something and you can do some give and take, and you can go back and forth. It's not set in stone once you get your LOI, but yeah, just keep that in mind. You want to come to terms, make sure all the terms are what you were thinking and what you're comfortable with. Next, you're going to, once you come to terms on your LOI, your letter of intent, everything is great. You're going to execute that LOI. When you execute that LOI, traditionally or typically, the lender is going to ask you to place a deposit. It might be $50,000. It might be a percentage of the loan, whatever. This deposit gives them good faith that you're moving forward with them. And also, it's a non-refundable deposit. Also, when you place this deposit, the timeline starts so that the lender can order your third-party reports. Remember that don't order these third-party reports before you work with the lender, because a lot of times the lender needs specific reports, have a specific process of ordering these reports, and they need to order it, not you. So don't just say, oh, I'm going to get some lending in a few months. I might as well order an appraisal now. Don't do that. Wait until you work with the lender. The lender is going to want to order the third-party reports. Now, these third-party reports are an appraisal, an environmental report, and we'll do what's called a phase one and look for environmental concerns from a kind of a global basis through databases. Also a property condition report. They'll have an engineer go out there and do a condition assessment on the property and what needs to be, immediately fixed, or what are some concerns physically down the road. Some groups also, especially agency, they'll order a zoning report. So that basically it has a group that researches the zoning to make sure that your current uses is what's allowed in the zoning designation. So this is some of the third-party reports that are ordered, and that is done once you place your deposit. And again, don't order these reports until you talk with a lender, because they have a process to do that. They might say you can order an appraisal, but just don't do it before you talk to these groups. Next, what's going to happen is the lender is going to go through their full underwriting process. So you did provide some initial information, some financials, occupancy, rent rolls, things like that. The lender is going to send you a list of a lot more information that's needed. So it's going to take some time to go through and gather all this information, do the best you can, grab all that information, and usually it's put on a sharing site. Either the lender or yourself will have a sharing site, put all the information on there. You're now going to have at least weekly calls to go over the information, what's there, what the process is, where they're at in the process. But be prepared to gather and provide a lot of information. The sooner you can do it, the better, especially if you're on a tight timeline. Provide this information early. If you know you need some lending and you have a tight timeline, go ahead and start gathering a lot of the information that's needed. I mean, reach out to me. I can give you a kind of a basic idea of what's typically needed in an underwriting process, but you can gather that, information early so you have it on hand. So it's like, boom, you post it and be like, hey, here you go. Here's your list. I'm fast. So keep that in mind. It's there's a lot more information, even though you provided financials, occupancy, all that initially. Well, once you sign that LOI and you start the full underwriting process, there's going to be a lot more information, a lot of phone calls. That is going to take up a lot more of your time and energy, but you'll be going through the underwriting process. Also, you're probably going to engage counsel. The lender is going to have counsel, and you'll probably want to engage counsel too, because you're going to start negotiating and informing the loan documentations or loan docs. So you'll probably engage counsel at that time too. So after you go through the underwriting, your counsel is working and they come up with the loan docs. The lender's typically going to have a credit committee. They might have a different couple of types of committees, approval processes, but the lender is going to prepare a memo, typically a presentation that they're going to present to their committee talking about this specific loan to this specific property. So a lot of times right before a loan committee, they might be reaching out to you with a lot of different questions because they're preparing their internal documentation for their committee. I used to go to what's called investment committee, we call it ICOM, but we did a lot of packages and then we had to present that to a committee before we actually invested or closed on any of the new acquisitions or development investments. So there's a lot of juggling, of running around, of getting everything together. So I would understand what the timeline is for them to get this approval or go through the approval process. So you can be available if you're in Bora Bora on, no access to email right before they go to credit committee. It might be a tougher time. So it's great to understand what their timeline is internally when they go through their approvals and be on hand to answer any questions that might come up. Once they go to credit committee and they get their approval, everything is golden. You're going to get offered a full commitment, and if it's a fixed rate, you're going to get offered a rate lock. This is great information. Everything's rosy. Everything's awesome. It's great to get that full commitment rate lock.
We appreciate you participating in the
after
inner
you
circle
celebrate,
of senior
then
living.
usually in
Now, it's
whatever
your turn
days
to help
you'll
spread
have
the
closing,
message. Be
and
sure
all
to
the
share your
capital will
questions and
be
comments with the
closed
Inner
and
Circle
provided,
community
and all the
discuss
documents
different
signed,
topics with your friends and
and
colleagues.
everything
Until next
is
time,
finished.
thanks for joining.
So
the Inner
that's
Circle
kind of the
of
quick
Senior
guideline, the
Living.
quick outline of what the lending process is. Again, every process is different. There's going to be a lot of different questions and fires that pop up, and you'll be running around trying to keep out different fires, get new information, answer questions, talk with appraisers, or coordinate site visits and things like that. So there is a lot of different intricacies that go into this process, but this is the overall guideline of the lending process itself. That's it, guys. Financing is so important to any senior living investment decision. And again, I just truly recommend you work with a group that has solid experience and understanding of the senior living industry itself. Talk to them about their prior deals. Talk to them about their experience, because that is very important in this process. If you have a group that's new to it, then it's going to be a lot more intense. I'm glad to help out any way I can. Feel free to reach out to me. You can shoot me an email. The best way is Scott, SCOTT at srgrowth.com. That's Scott at srgrowth.com. I can help you out. I can give you recommendations. If you're a lender and you want to get involved in this show because financing is so important, feel free to reach out to me too. You might work on one of these products themselves, and you want to get involved with the show. Shoot me an email. We can definitely talk about that and work something out. You'll want to get engaged in our social media. We're on the Gram. We're on the LinkedIn. We're on the Twitter. We've got a YouTube channel. All great ways to get involved. I'll be posting questions and theories and concepts out there, but I want to hear your feedback. I want to hear your interaction. What's your preferred lending source? What is your experience with a HUD product? I want to hear from you and what you like about the senior living industry, and also specifically the financing of senior living. So get involved. Find that, especially the LinkedIn group. That's where we're going to be most active. But I want to hear your thoughts and learn from you as well. If you have any questions, show ideas, interviews, reach out to me. Would love to interact with you. Look forward to talking with you. Look forward to meeting you in the future. Please subscribe to this. It's the best way to get the newest releases of the show. We'll be releasing them periodically or, as often as possible. But if you subscribe, then you'll make sure you'll get the latest and greatest for the different shows and interviews that are going to happen down the road. If you could leave a review, 5 stars would be great. But if you could leave a review on this, that's a great way to increase the platform's awareness so other people will be able to find this show. Absolutely, if you could as well, share this with your colleagues, man. That would help out a lot. But talk to your colleagues, your friends, different people you talk to in the senior living industry that shares the same passion as us. Tell them about this show. Let them get involved. Again, this is the Inner Circle. This is our mastermind, our collaboration. So make sure everyone gets involved with the Inner Circle, especially your colleagues or different people you talk to that share the same passion as us for senior living. That's it. I hope this was helpful for you. I hope I could enlighten you just a little bit and share some of the knowledge and experience that I've had financing different projects down the road. Would love to hear from you. Look forward to meeting you. But as always, go out there in the senior living community and make a difference.
We appreciate you participating in the Inner Circle of Senior Living. Now, it's your turn to help spread the message. Be sure to share your questions and comments with the Inner Circle community and discuss the different topics with your friends and colleagues. Until next time, thanks for joining the Inner Circle of Senior Living.